Gap trading like a pro, a step two. Gap trading like a pro, a step two. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders, and our website is www.stochastic-market.com, www.dayprotraders.com, www.24elliottwaves.com. The title of this video is Gap Trading Like a Pro, a Step Through. All right. If you have not watched part 1, okay, we recommend to traders to watch part 1, okay, and to understand, okay, the market participants that create a price gap. In step 2, we will be talking about the factors behind a price gap. All right. What are the factors, okay, the causes of a price gapping up or gapping down, all right? So a financial instrument may gap up or gap down. Here you can see that Google stock gap up from here, where my cursor is, and up to this point here, all right? It's a gap, it's a bullish gap, okay? And sometimes you may see a financial instrument with gap down, which is probably going down from A to B, all right? So what are the factors that can create price gapping up or gapping down, okay? So stay tuned, all right? So the first factors that can create a gap are last minute orders. So this is what I say to traders that are trading stocks. All right, if you trade stocks, all right, my friend, you want to understand orders. Orders to buy, okay? Orders to sell. All right, and these orders, okay, are like a magnet. They attract the price, all right, and sometimes price will gap down because of orders to sell, and price will gap up because of orders, all right, to buy, all right. So you want to know where are the orders and when these orders are placed. And one of the factors of price gapping up or gapping down are last minute orders. You want to understand this clearly, my friend, and never to forget this if you trade stock. Otherwise, you better look for something else. All right, this is serious. That's all. That's what I meant by that, okay? So don't get upset. That's what I meant by that. This is serious, okay? So, when New York is open, okay? When London is open, when Hong Kong is open, all right? When a financial market is open, a stock market is open, all right? The first 30 minutes, big market players will place orders to buy or to sell. So usually, these are not real trading activities. So in the first 30 minutes, okay, brokerage firm will fill orders for their clients. So client A will say, I want to buy X stock. Client B would like to buy Y stock. Client C would like to buy Z stock, all right? So these orders must be filled. And as the market opens, during the first 30 minutes, these activities taking place. They are buying for their client or they are selling for their client. So what do I mean by selling for their client? So they are shorting stock for their client or they are closing position for their client. They are coming out of some trade. So during that first 30 minutes, these are orders to buy, orders to sell. Okay, these are orders that can also come into the market during the first 30 minutes. Okay, now talking about the factors that can create gap, we are talking about the last minute orders. So as you have seen, when the market opened first, the first 30 minutes, we see orders being filled. Okay, the same thing happened. Okay, the same thing happened when the market is about to close. The last 30 minutes, in fact, the last hour, all right. The last hour, when the market is about to close again, there are orders being filled again as it was at the beginning. You remember this sentence before? As it was at the beginning, so it shall be at the end. We understand that. We that use Elliott wave, we know that if the third Elliott wave is extended, there is usually equality between the first and the last wave. So what has happened at the beginning of the market is likely to happen at the end of the market. You want to understand that, okay? And fear God because of that. Okay. Now, so This is to make you laugh a little bit, okay? So as the orders are filled the first 30 minutes when the market is open, usually at the end of the closing, okay, the last 30 minutes, orders are also filled. So apart from the last 30 minutes orders, there are other orders that come in very, very late. These are smart traders. So they don't want to be taken out of the trade before the market is closed. So they don't want to enter the market at the beginning of the last hour before the market is closed, or at the beginning of the last 30 minutes before the market is closed. They want to enter the market a minute or 2 minutes or 3 minutes or 5 minutes before the market is closed. The reason is they want to leave that trade open. They don't want to be taken out of that trade, and use a tiny stop loss and see what's going to happen the next day. So these last minute buying orders can create, okay, a price gap. Price may gap up the following day if many market participants place last minute orders to buy a financial instrument. The opposite is also true when the next day the market opens and you see that a financial instrument gap down. Last minute orders can also force, okay, a financial instrument to gap down. So traders that are very, very smart wait till the last minute to sell a financial instrument with a tiny stop loss, okay, and they leave the trade in the market, and the following day, and sometimes it works beautifully, and they probably gap down, and they will quickly grab their profit. All right. So one of the factors that create a gap, a price gapping up or gapping down, are last minute orders. Okay. So now we talk about the market participant that creates gap in the first part of this series. Okay, gap trading like a pro. Step one, we were talking about, okay, high frequency traders. Okay, Elliott with trader, fundamental traders, and the high frequency traders are usually last minute, also take part in the last minute orders. So these are high frequency trading firms that are using computer algorithm to place a trade. This computer algorithm detect a bullish trade in the last 5 minutes before a market is closed. These orders can create a price gapping up the following day or price gapping down the following day, because if many of these if these are big orders to sell in the last minute or big orders to buy in the last minute, okay, the stock or the commodity may gap down, may gap up the following days. These are last minute order, number one factors of a speculative gap. All right, so there are different type of gap. I will talk about it in part 3. So that's why you should watch all these series of videos. In part 3, I'll be talking about different type of gap, the long-term gap, okay, the short-term gap, speculative gap, continuation gap, exhaustion gap, opening gap, okay? So, but these last-minute order usually create, okay, what we call speculative gap, okay? Another factor that can create also, okay, a price gap are big institution orders. Now, my friend, you want to understand this. Maybe you are a new trader. No one ever told you this. All right. So here it is, an opportunity for you to understand what is happening in this messy market. All right. Now, big financial institutions do not like to reveal their positions. They don't want other market participants to know that they are buying or they are selling. You need to understand that, and you shouldn't forget it. Okay. Big financial institutions hide their footprints. They don't want people to know, but we can know. All right, I will be recording another video later on, and I can tell you a few things that you can do. But they are getting very, very smart, and one of the way they can hide their positions, all right, what they are doing, their footprints in the market, is to enter the market the last minute before a market is closed. So, my friend, you want to remember that, especially if you trade stocks, okay, you want to remember that, okay? So last minute before, in fact, the last hour, or especially the last 30 minutes before London, New York, okay, Hong Kong is open, is about to close, this big institution will come into the market and place orders. But usually they place their order bit by bit, because they don't want to reveal their footprint in the market. So if we see a surge in trading volume, they expose themselves, we know that they have bought it, okay, or they have sold it. We can analyze the following price action. Talking about the volume stock trading. Check it out at dayprotraders.com. Volume stock trading. All right, surge in trading volume can reveal their footprint, but sometimes they don't want to do that. So they are buying bit by bit. So to hide their buying or selling activity. So, for instance, they may decide to buy a bit at 9 o'clock, another bit at 12 o'clock, another bit at 2 o'clock, another bit at 4 o'clock. But as they are buying bit by bit or selling bit by bit, the last bit that they buy sometime is during the last minute that a market is about to close. So these type of big institution placing orders to buy or sell during the last minute before a stock market is about to close or a financial market is about to close can also create a bullish gap or a bearish gap. Price can gap up, price can gap down. So the number 2 factor for a gap price action is big institution orders. All right. The third factor of price gapping up or gapping down are market forecasts. All right, my friend. I do not charge traders for Elliott forecast. Everything to do with Elliott is free at 24elliott.com. All right. So market forecasts can also create gaps in the market. All right. So traders that are reading the price, traders that are applying the Elliott theory, traders that are trading patterns may also create a gap. So they see a pattern that has been completed, all right, a clear-cut pattern being developing, and they are trading a part of that pattern. The following day, the price may gap up or gap down. So one example is this, my friend. Is that the price going up, okay, and come down one, okay. So I don't want the video to be too long, so I'm going to go very fast. I'll come down, okay, 1, 2, 3, all right. So the first part is 1, 2, 3, 5, 1, 2, 3, 4, 5, and then 1, 2, 3, and then 1, 2, 3, 4, 5. Bringing the price nicely, okay, to, for instance, to 61.8%, or in a zone between 50% and 61.8% Fibonacci retracement level. Market environment is suitable and viable, and then we know that, okay, this has a high chance to go up. So Elliott forecast, market forecast, can also create gaps if, repeat, if, okay, a majority of market participants have noticed that a financial instrument is due to go out, and they are forecasting the next price move, that there's a high chance that the price may go up, and everybody's buying. This can also create a price gapping up or gapping down. Okay, so market forecast is a powerful service in the financial market that are used by the hedge fund, the banks, the mutual fund, the big institution. All right, so they refer to market forecast services that are telling them that, look out, this stock has a high chance to start a bullish trend. So the frenzy to buy begins, okay? All right, or this stock, this financial instrument is now overbought. No one should buy it, okay? So market analysts forecasting the markets, Elliott practitioner forecasting the market, can also force a financial instrument to gap up or to gap down. So these are the factors, the number 3 factor that can also generate price gapping up or gapping down. The last factor that can also generate price gapping up or gapping down are accumulation and distribution. Accumulation is the activity of buying a financial instrument bit by bit over a period of time, okay, or the activity to sell a financial instrument gradually over a period of time, okay. So when we say accumulation, We are buying bit by bit over a period of time. When we say distribution, we are selling bit by bit over a period of time. All right. This kind of activity can also create a gap. It's like a pressure. Okay. So as we are buying a bit by bit, and we are keep buying more and more. Okay. It will come to a point when the price will burst out. It's like a pressure. So accumulation. We are pressing it. We are buying bit by bit, okay? 1 million share, 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 1 million share. No one knows we are buying, we are just buying. Another 1 million share. Next day we say to our broker, buy 1 million more share for me, 1 million share, 1 million share. And at one point, boom, the stock gap up. People say, what's going on? Somebody has been buying this stock gradually. All right? So the accumulation can also propel the price to new highs, okay? Or we know that, okay, this is the end of, okay, the bullish trend. No one should buy anymore in their, okay, normal common sense. They should take their profit and come back the next season because this is the harvest time. One should not sow all season. There is a time when one should harvest. All right. So in the stock market, we harvest. So we say, okay, it's now time to grab profit and go on nice holiday and come back the next season. So what do? We have portfolio full of bullish stocks. Now it's time to harvest. Okay. Maybe these hedge funds, these banks, these big financial institutions were in this trade for nearly a year. Now it's time to grab some profit and come back the next season. Or we have been buying this stock at every price all the way up here. Now the stock is overbought. What's the point of buying it too expensive? Okay, let's bring it down more. Okay, let's bring it down a bit. Okay, before we can buy again. It's a good company. No one can deny it. It's an excellent company. They are making money. So what? But we don't want to buy it at any price. We want to buy it at the best price. Now it's a big expensive. Okay, it's 5 times their sale, more than 5 times their sale. Okay, what's the point? Okay, let's sell it now. So bad. Because we have a huge portfolio of this stock, we can't sell it in one day. If we sell it in one day, we may distort the market. Big institutions are not allowed to distort the market or sell a huge chunk of stock in one day. So this is the start of a distribution. So they will start selling bit by bit. So price drop down, and then consolidation, and then drop down, and then consolidation, and then drop down, and then consolidation. And one particular day like this, boom, it gapped down. All right? So we are selling 1 million share, 1 million share, 2 million share, 3 million share, 1 million share, 5 million share. And then one day, this is a distribution gradually over time, and then boom, one day, the stock gap down. So accumulation and distribution can also create gaps in the financial market. These are usually long-term gaps. All right? In part 3, we'll be talking about speculative gap, long-term gap, continuation gap, opening gap, and exhaustion gap. To summarize this video, talking about gap trading like a pro, step 2, all right, we were talking about the factors behind price gapping up or gapping down. The first factors are last-minute orders. Second factor is big institution orders. Third factors, market forecast by market analysts and Elliott waiver, okay, practitioners, okay, and the last factor, accumulation and distribution. In part 3, we will be talking about different types of gap. This is the end of this video, talking about the gap trading like a pro, step 2, all right? If you like this video, please give us the thumbs up. If you dislike it, make sure you give us the thumbs down, all right? If, okay, you love this video, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our videos, okay, this is the time to subscribe to our channel. Check the link in the description section. Click on subscribe, and you may stay tuned and watch more tutorials like this. We are the TSTW24 traders talking about gap trading like a pro, step 2. See you in part 3. Thank you for watching, and we will speak to you very soon.